Great. Hi, everybody. I know that thank you very much for joining. This will be the last London FX breakfast of the year. Again, it's been another kind of positive tone generally. It's been a good, we've had a fairly good week. What started as looking pretty shaky on Sunday evening when Asian markets opened has kind of come back. The euro is looking strong again. It's above 131. A lot of people weren't looking for that, that's for sure, especially not towards the end of the year. People thought it would weaken, but it hasn't. And that's really just followed the whole of the risky asset class spectrum higher, if you like. So we've seen stock markets open high again. And obviously, you know, the euro is still looking very strong. It's just about the top of its range. 131.30 has acted in very strong resistance today. And that, so 131.28 has been the high. It did get to 131.30 yesterday, but again, that 131.30 level, it's come back and it's trying to push against it again. So essentially, if we bust up above here, just bear with me one moment, I'm just going to pull up my own chart and then I'll show you my chart. In one moment. If we get above 131.30, then we need to kind of really break above that kind of 131.50 level, and then obviously that opens the way to kind of 131.80 and into 132. So 131.50 is a really key level which I'll talk about. So anyway, as I said, thank you all for joining. I'm just going to put on my camera. Bear with me. So the chart in front of you now is just a point and figure. It's just a 4-day point and figure chart on euro dollar. So as you can see, really, you know, over the past week, look at it. I mean, you know, this picture tells 1,000 words. Top of its recent range, but again, that 131.30 level here is acting as key resistance. But it keeps trying it. So that's like, you know, a bit of a double top going on here, or triple top going on here. We do need to kind of bust above there really to then open the way to that 131.50 level. Now, those of you who will remember, the 131.50 level had been the low from October. So kind of at the start of this month, we had been talking about how that was going to be the key support level. Well, it didn't really last very long at all. So maybe 131.50 isn't significant, but it will be a number that's on the market's minds today. So it is worth watching. I'll just show you. Great. Let me just pull this up. You should be able to see my e-signal chart now. Again, just in a bit more detail about the pound. Now, this is just, let's just work backwards here from the daily chart. So as you can see, it looks like it's turning up just a little bit there on the MACD. I draw your attention to. And that's kind of followed this kind of bounce back from 130. Now, those of you who join this webinar consistently will know that, you know, 130 is a level that is so respected by the markets that we do expect, we did certainly expect it to be a very sticky level, that's for sure. On the upside, let's see what kind of the more nearer term. Now that was the daily. Now this is the hourly. So it's crossed above its 200-hour moving average at 131. Again, another key level. It's done that. Is running into a little bit of resistance. As I said, 131.30. Now where does it go beyond there? Beyond here, let's go back to the 60-minute chart to try and figure that out. Beyond here, we really are breaking new ground. So as I said, 131.50 and then 132. Now on the downside, you've obviously got 131, which is now going to act as really key support after that resistance level was broken. And then you've got 130.50. So these kind of, you know, SMA, these moving average levels are going to, you know, be pivotal at this stage because, of course, we had such a sharp drop that there aren't that many natural resting places. Of course, we'd certainly look at kind of 131, 131, 131.10, and then below there kind of 130.70 ahead of, obviously kind of the big one, which is 130. Just to draw your attention here to the hourly MACD, so on the shorter term basis, that is kind of trading sideways. What's it doing on the 15-minute and a very, very short term? Again, all trading sideways. Again, that's the same for the 30-minute one. So again, it's just they tend to do that when we're running into these key resistance levels, and 131 is. Whether or not this having another go at 131.30 is going to be enough to really push it up, well, we'll just have to wait and see. We certainly saw 131 kind of get, well, you know, the bears got a bit worn out really. That resistance level just kept on being hammered and hammered, and so then it kind of surpassed it. So we could see the same again today. What is driving this kind of better sentiment? Well, the long-term refinancing operations, the first ever 3-year long-term refinancing operation is taking place today at 9:45. And that's by the ECB. So the ECB is essentially offering 3-year, incredibly cheap money on great terms to Europe's banking sector to prevent a liquidity crunch. Is it a version of QE by the back door? Arguably, yes. They're not sterilising all of it. That is their policy, is to sterilise all of it. Hence, it's not official QE. But they're not able to. They haven't been able to mop up all that liquidity, and that means that that there is a widening of the ECB's balance sheet. What does that mean for you guys? That should be negative for the euro. Okay, it should be. But like we've seen with the dollar during QE, the dollar tends to rally on the back of a QE announcement. It boosts sentiment generally. It certainly boosts appetite for risk assets. Also, I think a lot gets priced in beforehand. So there's a lot priced in already for this kind of liquidity boost, if you like, that the ECB is giving the market. Thus, it may take a while for the euro could actually grind higher for a while longer before it kind of dips lower and embarks on that kind of other leg lower that people are looking for, kind of that real convincing break of 130, which we obviously haven't seen yet. So that is just something really key to watch. Yes, an expansion of the ECB's balance sheet should be negative for the currency, but the way in the past that we've seen, especially with the dollar, is that the dollar tends to rise on the back of QE for about a month or so, and then it comes off sharply. Now, could the same happen with euro? Well, the euro, they're two different beasts, of course, but potentially yes. We are looking at that. Now, someone said, what figure would be viewed by the market as disappointing? Now, I assume what you mean by this is the uptake on that long-term refinancing operation. Well, I've heard many figures, everything from, I think, anything below 200 billion would probably be considered slightly suspect. Not necessarily disappointing. I'm not sure that's the right word, but I would say suspect because then people might worry that the banks aren't boosting their own liquidity levels enough, and that comes with its own problems. Obviously, we don't expect any more than kind of 400 to 500 billion, but essentially is nice cheap money. And I will show you something else. Just bear with me one moment. Interestingly enough, as people have been talking about QE or about this kind of long-term refinancing operations that has really boosted the euro, boosted other risky assets. This is a 10-year Spanish bond yield. As you can see, look at that. What a dramatic decline. For those people who've been trading bonds and trading government debt, I'm not sure if any of you have, but I'm sure you've been following it very closely. If you just lost out on that 100 basis, if you kind of had like 150 basis point move against you, that's a huge, shocking loss you're taking on there. And this to us is kind of all the pricing in of the extra liquidity that has been offered to the banks. So really this has been kind of fueled from that coordinated central bank action and then the LTRO financing operation or the boost to it from the ECB. So this, in one sense is this quantitative easing. Well, there is certainly some expectation in the markets that it kind of is. Number one, the banks, if they want to access these funds, need to post collateral. Some of that collateral, of course, will be Spanish debt, hence why there's been some demand. This is all demand because obviously the yield has fallen, prices have gone up, as demand for government debt has gone up. That's what this means. I'd also just draw your attention to the legend over here. The average of this year, so this goes all the way back to 2010, is 5.44%. What is it now? It's below that. It is at 5.07%. Now that is, a good move, right? So that has been a good move if you've been long Spanish bonds, obviously not if you've been short. But what we would just point out is that obviously, some of the upward pressure on the bonds, some of the buying pressure on Spanish bonds have been by the banks to actually get access to this liquidity because you do have to post collateral. So whether or not it lasts, we'll have to see. But obviously, some at the ECB are hoping anyway that the banks will get all this money and then they will buy more sovereign debt. Now, I'm not 100% sure about that, largely because I think that banks are trying to consolidate their balance sheets. So that is something. So loading up on kind of suspect sovereign debt probably isn't going to help. But it certainly will be an interesting one to watch. So we could actually see a little bit of weakness coming into the bond market, especially if we were to see kind of a disappointing figure. So as I said, anything probably below 200 billion, maybe 150 billion actually. Maybe I'm being a bit too optimistic, I'm not sure, but 150 to 200 billion, I think that people may worry a little bit about that, because obviously this is just to kind of cover banks and make sure, and they deal in trillions every day, so it's just to make sure that the oils of the machine is still working. Added to that, of course, as well, Spain and Italy have 150 billion to auction in the first quarter of next year, so they're going to want a good bit of uptake, just to kind of ease pressures on that, if you like. Added to that, of course, once you have banks who have been refinanced by the ECB, it does take the pressure off the sovereigns a little bit, because it does make it less likely that the government's going to have to step in to bail out their banks. Obviously, Spain's banks are in terrible shape. We know that. There's probably a lot worse to come. They certainly haven't been that quick at writing down their real estate losses. Some of the banks in Spain, and we do know from the economic data is that the economy in Spain isn't fantastic, that real estate losses are still mounting up. There is still a crisis there. In fact, their newest Prime Minister, Rajoy, has actually come up and actually announced that earlier this week. So the fact that the pressure has been taken off to some extent about covering the banks from the sovereigns to the ECB, that could also explain this move here. Now, enough of that kind of fundamental stuff for those of you who aren't fundamental. And let's go back to the charts here. Let's look at euro pound, because obviously that's been a huge mover. Broke yesterday, well, been tested, obviously broke earlier this week, that 80, obviously broke 84, seemingly very easily. It then broke 86, which was kind of a key, or a short-term resistance level. Since then, support level, apologies. Since then, it's been testing 83.50. 83.50 is kind of the next major support of note. It's been sticky around here for the last couple of days. It's in a very, very tight range at the moment, 83.49 to 83.57. Markets are obviously waiting for the Bank of England minutes and the public finance data, which is released at 9:30 UK time. That will be kind of pivotal, if you like, to obviously the public finance data is just to see how far off track we are on our fiscal consolidation plan. Added to that, you've got the Bank of England minutes. Now, there is a chance they'll be very, very dovish, and that's probably why there's kind of real lack of conviction around this 83.50 level. So we do need to watch that. Something else that I would just point out, looking at the daily chart here, starting to move into very oversold territory, okay, which it hasn't really been in for a year. So the last time we were kind of down at these levels, this is the MACD. The last time we've been down at these levels, we saw a kind of a bounce back. Now, someone's asked a very good question, what are the lengths of my moving averages? Well, the length of my moving averages depend on my charts, obviously. The daily ones, these are daily moving averages. So the red line, so it always goes, so it would go kind of daily, 60 minutes, 8 minutes, 15, whatever. But I really only look at kind of moving averages in terms of the kind of 60 and daily, really. So this is what's consistent about my moving averages is that the red line is always 200, the yellow line here is always 100, the green line is 55, and the blue line is 21. So they're the moving averages I look at, and they're consistent across all my charts. And I always use the MACD, have the MACD up there as well. I know there's plenty of other indicators you can have. My opinion, and it's just my opinion, that I know some great technical analysts, that's for sure. But I like my charts simple. I like to look at them. That's why I like pointing figure, as some of you have probably noticed. But yeah, so euro pound. So I would just really point that out here. That MACD is starting to move into some oversold territory. And as you can see, on a very long term, or on a over the past year, we are nearing the lowest levels of the year. Let's just go way back. Actually, that's too far back. On a weekly level as well, we're getting, this 83.50 level is a really key level. This is real weakness here, even on the very long term chart. I mean, this goes all the way back to 2007. We've gone through some key support levels here, and it looks like it's kind of, still ripe for a bit more, bit for further sell-off, but we reckon maybe to about 80, and that actually it will be more of a slow grind lower rather than rather than just happening in a short burst. Now, someone's asked if I trade or I just teach. It's like, I am a financial analyst, so of course I do trade. But enough of that. Now, let's take a look at oil. That's another interesting one. Now, of course, oil is absolutely vital in the FX space. I mean, it's, if you're looking at, especially in the last few months, if you've been looking at FX, you've been trading the dollar, then oil has been a really interesting one for you to trade. Let's get this up. So this is just the Brent crude oil contract, and the reason why I'm looking at Brent today is because of the reason why I'm looking at Brent today is because it's open, because it's kind of European oil, and so it's open. Now, the one thing that I would point out here is, we did earlier this month try and break that 105 level, and didn't manage it. Now, I'm also drawing your attention to this area here, which is the 100-day moving average at 108.55, which we're currently testing. Now, above here opens the way to 108.50, so another 100 pips higher. And I think it really depends where it go, or where oil will go next. Really does depend on looking at where the dollar goes. It's very much moving. It's not really moving on its own fundamentals. There haven't been too much news. Obviously, oil stocks in the US are likely to actually rise, like oil stocks, certainly in Europe anyway, may actually rise over the Christmas holiday period, and that is because we're having an incredibly mild Christmas week in the UK. So that's just something to watch out for, which can sometimes have a negative impact. But that also has to be balanced out. I mean, there are many drivers of the oil market, right? So, you've got your own supply and demand. You've also got to take into account the fact that it's also a highly volatile commodity, and because of that has a lot of it's affected by market risk. And that is kind of the one thing that I would really kind of point out, is that overall, certainly in the very, very short term, I wouldn't really try to look at oil prices too much in the future, because it can be so volatile that you don't really know what's going on. So above here, then you'd look at kind of 108, as I said, 108.50 on the upside, if we can break above this 107.50 level. Now, if we can't, then we could see another test of this 105, but we haven't been able to convincingly break 105. So as you can see here, did break through it, bit of a double bottom here, but it hasn't really convincingly been able to do it. So there could be a bit of a rebound. And as I said, just looking at, let me just draw a couple of lines, hang on. So you've got there, we could obviously fall, oh, sorry about that. This is kind of a bit of a nice old trend line, potentially suggesting that we could kind of bounce, if we were to have another collapse, bounce off this 103 level before heading higher again. So just something to watch. We don't look like we're in a downtrend in any way. In fact, if anything, certainly the kind of chart pattern suggests that we're still very much in an uptrend, but we're just kind of weak within that uptrend at the moment. So obviously it depends, these are the levels to watch out for. Now, I think at the moment, certainly when we're in very thin markets with very thin volumes, firstly. Secondly, we've got, not only do we have markets that are very thin volumes, of course, because it's Christmas week, you also have, very uncertain conditions, both politically and economically. You've got kind of the risk of a big, massive slowdown, but then on the other hand, you've got kind of things kicking off again in the Middle East, which is really, for oil, likely to keep it range bound, because you've got these opposing factors impacting the price. Add to that, you've got some technical, now, that's the kind of fundamental picture. Looking at the technical picture and certainly the shorter term picture, as I said, it's moving very much with kind of overall risk sentiment. And while the dollar is lower, does tend to, have a bit of a negative correlation with the oil price. So as I said, watch where it goes from here, because it is testing. So it is just about breaking above. It's actually just taking off a little bit now above 107.50, and then above there we need to look at 108.50 as kind of the next resistance level. So if we can get through there, then we'd expect it to kind of run in, certainly in the short term, to short-term resistance at 108.50. So that's useful, hopefully, to you shorter-term traders. But as I said, still looking for, this is just the most active contract. There's no point looking at oil unless you're looking at contracts, really. And of course, if you do have to obviously watch for that. because a lot of oil, or the oil contracts will expire kind of anything between a month and 3 months. When someone just asks me, what am I looking at? I'm looking at simple moving averages. So all the averages that I look at are simple. If you are looking at kind of, I personally don't think it's worth getting yourself in a tizzy about whether or not to look at simple or exponential. Prices do tend to converge around certain areas. It's just kind of, I guess, the law, or the law of the land, really, that prices do tend to be mean reverting. And so thus averages are kind of the pivotal to everything. I like looking at simple moving averages and MACDs. They're my favorite. Fibonacci and obviously point of figure too, because to me the key is always going to be your support and your resistance levels, certainly if you're trading on a very short time frame. So let's take a look at something else. They were the kind of the major ones that I was looking at today. If anyone wants me to take a look at something, please let me know now. There might be someone interested in looking at Aussie, I guess, which we'll happily take a look at. Bear with me one moment. Aussie dollar. Again, this is the daily. Let's just look at it going from kind of one end of the spectrum to the other. Great bounce back, right? Been really, really good. Running into a little bit of daily resistance here. This is the 100-day moving average. Why is it 100? Because it's yellow. At 102-ish, kind of 102.10 there. MACD also on the daily basis, just looking up. Take a quick look at what the hourly is doing. Again, looks very strong. So what about on a short-term basis? Well, it does look like it's going into a little bit of oversold territory on the 30-minute, so just 15-minute. It suggests that yes, it is getting kind of extended on the upside of calls because it's up there at 102. 102 is a key resistance level, as you just saw here. It's that 100-day moving average. But what about above here? Well, above here you have to target kind of this top here. It was the kind of the short-term peak at kind of 103.66. If we get above there, then we could obviously then target kind of 104 ahead of 109. But we would be wary if we were to see a bit of a reversal here at this kind of 102 mark. That would worry me quite a lot for the longer-term outlook for the Aussie, because it would be a series of lower highs on a more longer-term basis, which is quite a neat downtrend. Now, one thing I would just point out to you as well, there you go, nice kind of that's quite a nice little downtrend going on there. Just erase that line here. As you can see, if we can break above here convincingly, again, break above that kind of 103 level, then we can target higher going forward. But we're at a really pivotal point for Aussie dollar, and it's looking very strong. Looking like it's in a strong position, so there could be further gains. But as always with Aussie dollar, it really is also benefiting and piggybacking a bit like the euro, a bit like the pound, on overall risk sentiment. So it's still very reliant on risk sentiment. The one thing that we would say is that at the moment, kind of headline risk has actually been quite quiet, and there hasn't been too much on the wires. And as much as, that can be, that means that, when comments do come out, they do tend to rock the boat. So far this week, we haven't had too many rock the boat type of, scenarios or type of headlines coming out. Added to that, we, just to kind of show you the fact that kind of how resilient this risk rally is. Now, obviously, one thing I would point out to you as well is that this, risk loves liquidity. It adores it. It sucks it up like nothing else. And this ECB move is a liquidity move, essentially. It's a massive, massive liquidity injection. Obviously, those of you who are following it, we are all going to be looking at the uptake. If the uptake is weak, then risk could sell off quite quickly. If the uptake is strong, then it's going to be very much risk on. And as I said, in the short term, we will be sending more research out about this later on today. But certainly in the short term, that would be, that could potentially be euro positive as it piggybacks on the back of kind of overall risk sentiment, weakening dollar. But then on the longer term, that could actually be very negative for the euro, because it tends to be when a central bank's balance sheet expands, its currency falls off. So do watch out for that. Someone's just asked, do I draw trend lines on all time frames through the close rather than the high or low? Well, I will draw them on all time frames. I quite like generally looking at kind of the close. when I look at prices. So if I just go back, just 1 second, I really like looking at, as I said, as you'll know, obviously kind of, I think you can draw trend lines. You can kind of see trend lines as well overall. I think sometimes people get a bit crazy looking at all trend lines. I like to look at the most obvious ones. For the Aussie, for example, there are, if you look at the 30-minute here, so this is kind of the trend line from the daily that's just come into the 30-minute. As you can see, it's had a really nice break above there. I think on the very, very short term, like the 30-minute to 15-minute, the trend lines are good, but I'd rather use kind of more solid indicators, because obviously trend lines are always a bit subjective. You can always get them a little bit wrong. So on the shorter term, I like to look more at my moving averages. What's my MACD saying? What's point of figure telling me? And then on the longer term, so like the daily charts, which kind of look at prices on the longer term, like over a 12-month period, then I really like looking at trend lines, because to me, kind of, the most developed trend lines do take a bit of time. Let's take a quick look. So that kind of certainly comes across from the Aussie. Let's just take a look at that point of figure chart. Bear with me 1 moment. Point of chart here in the Aussie, as you can see, this is the daily. That's a high-low price. Let's take a look at the close. And again, it just kind of evens it all out, right? Close prices are, if you like highs, lows, I guess it gives you a better overall sense of the market, because it tells you kind of about intraday volatility, that type of thing. But close prices are great to look at as well. I quite I like looking at both, if I'm totally honest. But close prices give you a really good sense. They strip out that noise, so that you just kind of see one price point. So as you can see here, this is the close price for Aussie dollar over the past year. The longer term, well, the historical basis. What does it show you? A couple of things here to me. It's weak within its longer term range, but here is a very nice trend line. The next key support is 99.50. On the upside, we do need to break above this kind of 102.50 level to then open the way all the way to 106, and there's not much there. Let's look at it on an intraday basis. Just bear with me 1 moment while the chart just loads. Sorry, it seems to be taking a bit longer than normal. Here we go. Goodness. Whoa, that's just gone a bit crazy. Just bear with me 1 moment. I'm just going to pull it up. Hang on. This is just a very, very short-term point of figure. And as you can see, this is again the close price. There isn't too much difference between high lows and closes actually for this. It just looks pretty similar. It's just had a stunning rally. So as I said, that 102.50, and then you obviously have to look at kind of 103 as your 200-day moving average. And then, there isn't that much, certainly in the Aussie, that could stop it getting as high as kind of back towards the 106, certainly on a technical basis. So if there are any other questions, let me know now. If there aren't any questions, everybody have a very nice Christmas. Enjoy the holidays if you are taking a break. Just to point out to you, this will be the last FX Street Breakfast of the year. It will be back the week of the 3rd of January. Have a really nice time, and good luck trading. As I said, watch out for those LTRO operations from the ECB today. That's really going to dominate things, and it's all going to be about risk appetite from what it looks like for between now and the end of the year. So thanks very much, everyone. Bye.